Longtime fans of the show should be familiar with the lender formerly known as Sue Pullen, and I'm pleased to announce that she's back, fresh off a rebrand and ready to help as Sue Mackey. Sue is a certified mortgage advisor at Fairway Independent Mortgage, an equal housing lender who focuses on finding the right product for you and your needs. She has over 20 years of experience helping thousands of homeowners. Whether it's purchasing, refinancing, or even a reverse mortgage, Sue will help. Sue's licensed in 36 states now, so reach out and let Sue Mackey it happen for you. The best way to reach her is just give her a call at 520-977-7904 or in an email, spullen@fairwaymc.com. Fairway Independent Mortgage has an MLS number of 2289. Sue Mackey has an MLS number of 206048. That email again, spullen@fairwaymc.com, and that phone number is 520-977-7904. Shoot Sue an email and let her know she needs to update that address. Disclaimer time. This is where I tell everyone to lighten up. It's just a podcast. Trading is like that roller coaster at the amusement park. Thrilling, unpredictable, and potentially stomach-churning. What works for one person might leave another clutching their hat in the wind. Our hosts and guests, they're awesome, knowledgeable, full of insights, but we're not financial advisors. So don't rush to make any investment decisions based solely on our banter. Always consult with a professional or do your own research. Plus, let's face it, we like to have fun, laugh, enjoy the trading ride together. It's all in the name of good podcasting fun. So remember, take it easy, don't bet the farm, and keep your seatbelts on at all times. Thank you for listening.
All right. Hello and welcome to the China Shop, home of the band of traders. If you're here because of the digital bond offering, then welcome. I hope you decide to stick around. I'm your host, Kyle, and today we're recording a very special episode. In fact, I'm sitting in a conference room with Eric Mason and Rick Coscia in the historic town of possibly the oldest functioning seat of government in the country in Quincy, Massachusetts. Eric Mason is the CFO for Quincy, and Rick is the city's Strategic Asset Manager. Now, I was led to believe that Rick was sort of Eric's sidekick, but after seeing Rick's credentials, I think we might have more of a puppet master situation.
I would agree with that, Kyle.
Rick, we're going to have to get you on, I think, for another one-on-one at some point here, man.
You just won't.
Well, the reason why I'm down here is because Quincy has done something that's never been done in the United States before by issuing a blockchain-based municipal bond. Now, there's a lot to digest in that statement, which is why we're here with Eric and Rick today. Our goal is to provide a resource for anyone out there wondering what the hell Quincy just did and what that means for the future. Before we kick off that discussion, though, I just want to say thank you for inviting me up here. My wife and I, we had a wonderful time exploring the sites in Quincy and the surrounding areas. Lori and her sister have been researching their genealogy lately, so it turns out she has more than a few connections to the area. Mary Perkins Bradbury is her 11th great-grandma who was tried in Salem, found guilty but escaped long enough for everyone to stop being completely insane.
Completely distressed that.
I know, right? There's Mr. and Mrs. Edward Fuller and their son Samuel, who came over on the Mayflower. Gillies Badgers, Captain Edmund Greenleaf, her 11th and 12th great-grandfathers who founded Newberry, and of course 7th cousins to John Quincy Adams. So we had a lot of fun checking out the sites and finding out all kinds of new details about these people. It turns out it's a bit of a miracle that she actually made it to today. There's quite a few spots where that line could have been snuffed out. If we have any extra time, I'd love to record a bonus episode with you guys just nerding out on history.
Oh, absolutely. 100%.
I know you're up for it. Now, the thing that really struck me most, though, during my stay here is just the outsized impact this town has had on our nation's history. There's so many firsts, like the Mayflower Compact, that had just much larger ramifications than anyone expected at the time. And it kind of sounds like Quincy might have done that again. So on that note, we should probably start with the obvious question here. Like, what did you guys just do?
Yeah. So, well, first off, I just want to say thank you to you, Kyle, and Lauren, and to Rick for, let's sit down and talk about this, because I think what's important about this is what we just did was complicated. It certainly was. And, I think it's the role of government, it's the role of Rick and I's job to try and be as clear as we can on it and walk through some of these complicated processes. Because, the fact that it is complicated, can make it can make it confusing to the people who should know how it works. And we want to sit here and take this opportunity to work with you guys who do a great job understanding both the complexity of these issues, but also making it into an entertaining and an educational experience to really disclose what we did. And I think that where it's important here is disclose is, we want the public and we want everybody who's curious about this to know why we did it, what are the benefits, long-term, short-term, and what are some of the challenges. I mean, this isn't going to be an info commercial. We're not selling you one of those convection ovens that can cook the full chicken that I loved to watch when I was sick and at home. So What exactly did we just do? That's a cool question. So we just took the first step in democratizing Quincy investment to the individual. So right now, the city of Quincy pays about $25 million a year in interest payments on our bonds. And those go to, large investors. They go to, I won't name any particular firms, but we all know municipal bond. And a question came about. We were talking about this probably about a little over a year ago. And we said, what would happen if that $25 million stayed in Quincy? What would happen to that? And, my background's in economics. I can tell you multiplier effects. I can tell you all that stuff. But at the end of the day, something that really interested me in this process, and something that Rick knows a lot better than I do, is that a lot of our debt is bought by SMAs, which are essentially wealthy individuals who just can buy bonds. That seems unfair.
Yeah.
We're government. It should be the wealthy individual who can buy the bond because they're a wealthy individual.
Right.
That's a broken system, to be honest. And this new technology, DLT, digital ledger technology, gives us the ability to take the first step, which we did here, to democratize that. A guy driving his kid to Quantum School, which, we just got MSBA approval to start rebuilding. As this technology advances, we took the first step in a reality where that man could take his 401k and invest in the school that he's dropping his kid off at, get that tax-free income, and, save for a future. He's living in Quincy. These are families in Quincy who can also invest in Quincy. And prior to that, that wasn't an option.
Right.
It was an option for ultra-wealthy individuals. And I think one of the reasons that we were able to do the first DLT-based bond in the United States is because we had different incentives in the private sector. The private sector, there's rightfully so, we're trying to make money for the shareholders now and in the future. That's not our goal. Our goal is to maximize and democratize every dollar that the city gets in here. It's to get the greatest return on public services for that dollar, and also make it as equitable and accessible to every individual. Those are different incentives, both noble incentives, but different incentives.
Right.
And so we were able to partner with JP Morgan. We were able to work through our great financial advisors, Hilltop Securities, our excellent bond counsel, bond counsels. They really, for something, this is more regulatory hurdles, and they were excellent on that. Lock Lord. But even people beyond that, even working with independent economic analysis through Dormanson Consulting, working with Blockwide's advisors to understand this technology and understand how it's going to be implemented. But then even beyond that, we have a great financial team that's always here, that's always working, and both internally and externally. And so I look at like Markham LLP, which prior to us using Markham LLP, they had recently merged with Powers and Sullivan. So Jim Powers and Todd Jertsky, your independent audit doesn't provide advisement on these things. It's still, a couple decades long relationship, and helping us understand good internal independent auditing processes. And you combine that together in this long march approach, and you end up being able to do something kind of special here, which is take a step to opening up the largest financial market in the country, the bond market,
Right.
to the individual. So that's why we did it. That was a long-winded answer, but
That's really cool, but I think there's got to be some other financial incentives for the city to do this as well, right?
yeah, no, the primary incentive here is really twofold. This current bond offering isn't going to offer any sort of financial advantage, but it opens the door to pronounced financial advantages down the road. The first time you do anything, you're not efficient at it.
Right.
You're doing the first thing for the first time. We could see documentation fees be cut by half. We could see open transactions. So two parts is issuance costs can decline because blockchain technology is incredibly good at record keeping. That's actually right. But the second is, as you open, this is from an economic standpoint, as you open the market. So supply and demand, as you increase the demand for, or you can look at it two ways. You could say increase the demand for bonds, and by having bonds in a more open market, you can increase their accessibility. This is a more principal agent thing. If you are the only operator in the market for, say, a blockchain, somebody wants to buy a blockchain-backed bond, that really helps you with the price setting.
Right.
The second side is increasing the supply of buyers. So if you democratize this, and suddenly anybody who has $5,000 can suddenly buy your bonds, they don't have this huge hurdle like SMAs. Suddenly, you can see more bids, and that can suppress interest rates. And on one final note, when we talk about sequential oligopolies, which is really what bond markets are, the first actor, the first person to in a sequential oligopoly gets the greatest benefit. The metaphor I always use for this is, I'm a millennial, so I grew up with like Razor scooters. Whenever I give this example in class, I'll be like, name another company that made scooters. Other companies made scooters, but
you don't know the names.
You don't know the name of them.
Yeah, I would say jump in here, and Eric is exactly right when the first point he made is like why we do this in the democratization of the process of buying bonds. Now he talked a little bit about SMAs and high net worth clients buying those bonds in terms at the individual level, and he's exactly right. But I would also add that pool is actually even smaller because when we sell our bonds and we're a AA S&P rated credit issuer. Majority of those bonds, if we're going to sell $100 million, whatever it is, the majority of that, yes, there are some individual high net worth and SMA buyers, but the majority of that is taken up by institutional investors. Right. They're going to be insurance companies. They're going to be investment management companies. Just those type of asset managers that match their assets with their liabilities. So that pool of available bonds is actually even smaller. We do have, we can see on bond day, on sale day, we can see who's buying those bonds. And yes, there are some very affluent people buying them in that, but that actually is a fairly small amount. Those are being absorbed by either brokerage houses, individual institutional investors, institutional asset managers, and insurance companies. And the other thing I would just say too about the kind of jumping on Eric's example about the Razor scooters is ultimately what is the goal of going in this platform? And there are going to be some advantages. Now, all those advantages won't be here at day one, but they are the instantaneous ability to access those funds, lowering the transaction costs, the reduction in the removal of potential, as many intermediaries. Because now, when you issue a bond, not to bore everyone with the process, but there are underwriters and there are custodians, all those things. Those things will all apply, but that number is reduced. And when you reduce intermediaries, what do? You kind of compress costs down. So that's ultimately what the objective is. Again, but this is the first step to kind of opening up the ability to buy bonds, but also, for the taxpayer, for the city, that our debt service would be lower because we don't have as many kind of built-in costs.
It seems too, as I was reading through just the process that you have on there, you have a period where you do, I think it was called rate squeezing, where you start to lower the rate and then check to see what kind of subscription you still have to the bond offering. So the more people that you can open that up to, then it seems like there's more opportunities for the city to be able to save on the interest rate. And how much does a percentage point on a $10 million bond give you?
Yeah, huge amount. I mean, on 20, it could be 300,000 or 400,000. No, you're 100% right, buddy. Like you're right on. That squeeze period is so important. And the more people you have sitting in the market, that's the more people can ask, hey, how much will you lower it? How much will you lower it? How much will you lower it? And when you democratize stuff like this, you just have better access to being able to suppress rate. Again, like Rick said, not going to be there day one, but you don't climb Mount Everest in the first step.
Right. Kyle, I've already bored you with this analogy, and it's a clunky analogy, but I think it's accurate. It's the ATM analogy. Years and years ago, the banks and institutions instituted ATMs, and everyone thought, well, who's going to want to be able to go outside, at 11 o'clock at night and take out $100, right? And there's another startup cost, right? There was a startup cost, there's a technology cost to that, but that has taken off right now. Now it's to the point where most people do most of their banking remotely. Now that hasn't done away with the traditional way of doing banking, right? That we talked yesterday about banks are increasing the number of branches that they have and tellers that they have and services that they provide. They've kind of that model of banking has changed a little bit. So they both coexisted, but it's an additional transactional resource that now the consumer has, and it's obviously taken off, and it gets, and you can see it in your checking accounts interest rates, right? Like it's allowed the bank to reduce costs. That's not a perfect example, but
it's a good example.
It's good because the ATM didn't eliminate the bank, but it changed it.
It changed.
Yeah.
And I think that's kind of what you guys are getting at here. So how does this actually work then? Like, you're taking blockchain technology and you're applying it to bonds. Can you kind of tell me exactly, or maybe high-level overview of what that integration looks like, why that's appealing?
Yeah, absolutely. So, obviously Rick can jump in here too because he knows it very well. But so bonds don't trade that well. Generally speaking, municipal bonds trade about once a year. So, which is insane. That's such low amount of trading. When you have a more stagnant market, it's hard to express menu costs, basically, is what we call in economics. When you don't have transactions, you don't have price efficiencies.
Okay, too much time goes by before you get a chance to reevaluate what the price of that thing should be worth.
Yeah, yeah, right on, exactly. It's like, you have gold, you can have gold sitting in the corner and you paid $2,000 an ounce for it, and in your mind it's $2,000 an ounce, and it's 2,000 until you sell it. It's unrealized gain or unrealized loss. Part of that is because bonds are difficult to trade, just in general. Like, you can have bond funds and stuff, and the private sector's done like an excellent job of trying to add velocity to this market. But at the end of the day, bonds are blocky instruments by design. I mean, a bond is designed to be held and receive a coupon payment, and be a long-term investment. That doesn't disregard that velocity in a market's good for price maximization. The more transactions in a market, the more likely that market is going to be able to seek equilibrium, given that it's a non-restrictive free market. That's just the reality of the data we have to show us.
That sounds like that'd be very useful for you guys too, because trying to price one of these things, it's something that only trades once a year. Like, what is that? That process has got to be very nerve-wracking.
Right. So, Kyle, this is wicked interesting. So just a little sidetrack on this. Right now, when you price a bond, you're really not pricing a Quincy bond. You're pricing a tax-free AA graded municipal bond for some fixed term, which really means you're basically a proxy against the Treasury of that term, which is interesting because the Treasury has tax implications.
Mm-hmm.
So there's a data series on the Federal Reserve called HQM, High Quality Market Bonds, and you can actually almost perfectly tether Quincy or any municipal bond to that. And what's something like, we do some pretty robust data analysis here at the city when we're measuring all our bonds and stuff, which is all our financial analysis data, and you can tether it. But it doesn't tether perfectly to, like, AA doesn't tether perfectly to HQM AA with some gap or tax advantage. So what ends up happening is you're basically trying to sell in the market with, and this is why negotiated debt's great, don't get me wrong. You're basically trying to say, hey, will you pay more for this? You pay less for this? Like, we sold bonds at the first offering, it's 8 times oversubscribed. We're not priced right?
Yeah.
Ramirez and Company, who was our underwriter for negotiated debt, amazing. They're great public sector. They're great underwriters, but they're particularly, excellent in the public sector. They do a good job of pinching that. But if you have back-end transactions, in a secondary market, by proxy, you know what the price is.
Right.
And to give you an example, what's more valuable, a U.S. dollar write-off, freshly printed, or a U.S. dollar that's been around in circulation for 3 months? The same value.
Yeah.
Because they're transacted at the same rate. Can't say that about a bond. Increased transaction optimizes price. A U.S. dollar is a U.S. dollar. $5 for a Quincy bond at 5% should be the same value, except you're speculating because it's not like those bonds are rolling off a printer every day.
Right.
And I think that's really the interesting part about this is adding transactions will help us. And, it's, right now we're early in the process and it's exciting. Like, this is an awesome opportunity we've had. A lot of hard work by a lot of people. I mean, I'll tell you right now, Rick was the hardest working person on this.
That's debatable.
you can debate that, but
thank you.
And yeah, the increased transactions because it trades so slow, so it means we're gonna have a ton of data as these markets ramp up, and we're gonna be able to make better financial decisions as we go forward as we're trying to sell these.
So there is no secondary market for municipal bonds right now, is there?
Like, there is. It's very weak. I mean, if you have a velocity of 1 a year, are you really a market?
Not really.
Right. Not really, right? Like, it usually goes into these massive public bond funds, and those public bond funds, hold them because they want those coupon payments and they want to avoid taxes. I mean,
Correct.
Rick can chime in better than me here as a CFA and an MBA. What do you? I mean,
Yeah, no, that's absolutely right. I mean, the value of the municipal bond is always in those investors who are looking to kind of reduce their tax exposure. So, I mean, it's not a sexy asset class. You're not looking for growth. You're not looking for income. What you're looking for is some hedge against inflation, but you also want to
Safety.
It's a safety. It's a ballast, and again, it's gonna outpace inflation, but it's not gonna. The investor who is really interested in investing in municipal bonds doesn't care about growth or anything. They are at a certain level that their taxation is their priority. So again, that pool is, as Eric mentioned, is very kind of static, and it's the usual suspects, right? It's endowments, it's the foundations, it's high net worth investors, it's institutional investors. It's a mutual fund that potentially is going to be gobbling up the majority of our municipal funds because they're issuing they they issue or they manage a municipal bond fund. So they're looking for Massachusetts debt, which is Eric. This is where Eric can jump in really quick. Massachusetts debt is extremely attractive for all those reasons. One thing I wanted to back up a little bit, and when you were introducing us, you introduced me as a strategic asset manager. That's true. But the main reasons we are always looking into these endeavors, like how do we do things better? How can we do things more efficiently? How can we save costs? How can we think outside the box? I think in previous conversations, we've talked a little bit about how we issued a $475 million pension obligation bond several years ago. And that's because, it's not unique to Quincy, but a lot of the public funds, public pension plans are underfunded.
Mm-hmm.
And so, the strategy of doing that, and the strategy of doing this of the blockchain bond, it kind of dovetailed, because the mayor is, even though he's not, Eric will attest to this, he does not even have a computer in his office, is always looking for ways, always, encouraging us, like, look, we need to address this problem, or how can we save money doing certain things this way with frequent issues in the market? How can we think outside the box and do that? And so I always say, Eric, who's, embraces technology and, really drives a lot of these new initiatives. That's the strategy, right? I always look at myself as a tactician. Okay, like this is the blueprint we should use in doing this and finding a better way to issue bonds. But I always look at, strategy always drives us tactical, right? So, if the mayor and Eric, have decided that, we need to address these issues, whether it's an underfunded pension plan or whether it's how do we drive down costs because we're in the market so much when we're issuing our bonds, what other technology, what can we kind of be first through the door of? That's where we can work as a team and we say, well, this. So it's great to work in an environment like that where that's embraced, as opposed to saying, and especially in the municipal issuance bond market, it's a very, again, as I'm piggybacking off what Eric said, it's a very old school manual way of selling securities. And that hasn't changed in a long time. And we've had these conversations with our underwriters, and they've repeatedly remind us of that.
I noticed that when you have large institutions involved with something that's been around for a long time, they tend to not like change too much.
Bingo.
Maximize that efficiency, and they maximize efficiency.
Right.
Been around for long enough.
So is there any concern that opening things up to, I guess, more of the public would, I don't know if alienates the right word, but would there be less interest from some of these larger institutions knowing that you're kind of messing with their setup?
Well, this is where it becomes strange from our perspective. We are a security issuer.
Mm-hmm.
The city of Quincy issues securities, and we issue a very unique type of security. We issue a tax-free bond that is backed by the full faith and credit of taxing authority, mixed with the taxing authority of the state of Massachusetts, the highest HDI in the entire world, the state of Massachusetts, one of the most robust economies in the world. It's so baseline. It's such that it's what you need to base everything off of, because it's about as risk-free of investments you can have and be tax-free. So yeah, there might be some uncomfortability with it. And that's why I think the private sector would be less advantageous to be the first actors on it. So could it alienate some investors? Like maybe, but they need us.
Right.
They need us. Like they need access to tax-free bonds. And I think something that's interesting that's going to happen is, we keep seeing large federal deficits. Regardless of the politics behind it, we see large federal deficits.
Right.
That means that the market, we call it crowding out in economics. It means that the federal government goes in and basically crowd outs other issuers. They pull in all that debt, and basically anybody who wants to anybody who wants to be a supplier of funds to be borrowed, that all gets sucked up by the feds. And when you have $1 trillion deficits, that becomes a real thing. Now, this becomes this kind of beautiful dance that occurs afterwards, where it's saying these large institutional investors, they will buy up all those treasuries because they're great for your baseline rates. They're great for establishing in the Fisher equation, what is that risk-free rate of return? But they still have a tax implication on them. So what happens is you still get that bond, you still get that taxation, that's all good, and that removes a lot of dollars in the economy that could be used for borrowing. So you might have a small pool of investors who just simply won't touch anything with taxability. And we do see, as Rick said, you will see that with some corporate investors.
Mm-hmm.
But if that's a smaller pool of funds you're pulling from, they can charge a higher interest rate because of scarcity. As you democratize debt and you basically say anybody can, jump on these bonds, you're suddenly expanding that pool, which means you're suppressing interest rate without changing underlying, safety of this. Like if you can make bonds more sellable, you just increase coupon rates. I mean, Rick could call and increase the coupon rate and sell a bond quicker. But
Doesn't benefit the city though.
Bingo.
Right.
Yeah, we're fiduciary, so we can't do that. But instead, we can take this not as a demand side issue, but a supply side issue, and say, hey, let's let more people through the door.
Right.
Yeah.
Right. And I think, you're right on, Kyle, when you talked about, will this upend the apple cart a little bit? And it will. And I think there are some parties that it will. And I think, the jury's out on this, but I think on the underwriters, the underwriter segment, that may impact them because, if the transaction is that so much more seamless now and transparent and immediate, do you need an underwriter to kind of go out and sell, and as Eric mentioned, one of the main priorities Dr. Mayor Koch has kind of, asked us to kind of, that's why we're exploring this, is the opening up of the ability for Quincy people to buy bonds that fund services, buildings, activities, and infrastructure that they're going to immediately or directly benefit from. That's the benefit there. And if you can open up that market and to many investors, and you like I said, the impact on the interest rate they're paying, do you need? And this is the question. It's a more of a rhetorical question than a statement, but you need the underwriter's service there. That's to be. I mean, I think it'll be. I think I go back to that unelegant example of the ATM. I think they're going to coexist. Are we going to no longer issue bonds to traditional negotiated debt? No, that's not the case. But this is also another resource for us.
And Rick, just to jump off that, that's a good point. See, I do think the ATM example is good. I think underwriters are here to stay because I think they're going to handle the negotiation side of. I think this is going to happen. It's going to be very similar to the ATM. Like there's twice as many tellers today in the United States than there was when the ATM first came out.
Really?
Yeah, but the tellers aren't doing the baseline repetitive actions. I think you're going to see a huge value increase of underwriters because they're going to come in and they're going to understand timing in the market, which underwriters already do that. Great. I mean, Rick works with underwriters. He can tell you all day long how good Ramirez is.
If less of them can be dedicated to doing the administrative record keeping stuff, and more of them doing the skilled part of that job.
Right. You're going to have greater economic efficiency. I want to, just to editorialize this for a second, and Rick did a good job hitting on it. One of the big things, when we talked to the mayor about this, this policy originated internally, but it also originated with Council President Ann Kane, who's been a very big advocate of blockchain and digital ledger technology. His Cubic Labs actually hosts the Boston Blockchain Week here. And I sat on a panel with the CFO of Lugano, Switzerland, who actually sold the first municipal blockchain bond in the world. And as we sat down talking, you have Ann Kane, who's a brilliant guy and understands this technology to really an impressive degree. And, when we started talking about this, we looked at the deal that was done in Germany. I think that was the first blockchain bond. And, we had this the city is always adaptive to new technology and started talking through it. And it was cool to see, the heavy tech driving policy side. But equally, it was awesome to sit down and talk with the mayor. And the mayor was like, wait, this can democratize debt. Like we can have people investing in Quincy. And to see those two lines of thought hybridize to create like a better financial environment and political environment for the average Quincy taxpayer, I was like, that's awesome. I was like, that's really unique to see policy collide. I really think that speaks to like a lot of the financial decisions that get made in the city, like with the POB, pension obligation bond that we did. And, even when it comes to right now, we have a $157 million bond that's pending for our downtown investment, which is going to have like a medical office building and, large commercial grocery,
specialty retail, specialty grocery
that we're not allowed to disclose yet. It's because we do this like all the above approach. And the mayor doesn't have a computer in his office. But it's funny because he's never been afraid of technology on this stuff.
Right.
He's like, he gets experts, like he gets the Ricks of the world, and he brings them in and it's like, hey, this is what I want to do. If we can create better access for the average Quincy guy, like, why wouldn't you do that? And I'm like, there's a lot of people in government who don't do stuff like that. They don't think that way. They want to maintain the status quo as opposed to always taking steps to create a better environment for Quincy, for people who live in Quincy.
One of the thoughts that's come to my mind of like the implications that this could have is just thinking, as Quincy residents, if you are wanting to say fund some sort of improvement and that's something that you've believe in and want to support, now you suddenly have a way of influencing whether or not that project goes through. You can, if everybody wants to subscribe to this thing and support this project and put their money towards it, now the rates are going to come down. You're going to get better return on the dollars that you're borrowing, and it just makes everything better.
Yeah, it's funny when I sat down with we sat down with the mayor after we had first started exploring this. So he said, basically what he said to us was, guys, I like the idea here, I like the concept here, but like, this is what he says with projects like this. Anytime, the same thing with the pension obligation bond. All right, sit down, devote time to doing this, do the homework, come back to me, right? And he is the chief executive for the city. So we came back and talked to him, and we went through everything. And it is funny, like, he gets the technology, like, he gets it. Like, it's funny, if you, like, talk to him about, like, oh, like, I don't fully understand. I'm like, no, you get it.
Yeah.
Like, most people. And he says,
Smarter ones usually try to
get
off of it. Yeah.
Yeah, exactly. And so he says to me, we're sitting there, and he's a very, like, end goal guy. Like, what does this mean when the rubber meets the road? He respects the technical aspect of it. You turn the rudder, right? The technical aspect of it. But he wants to know where the ship's going. That's all, when it's all said and done.
Is there an iceberg to the left?
Yeah, right. And so his big thing was, like, de-risking it. Like, what are my, and I know we'll probably talk about that in a few, but de-risking it. Is this a greater threat to the taxpayer? Is this a threat to the city's financial health? And the answer to that question is emphatically no. In fact, in a lot of ways, it's safer to do it this way. But the second was, he said to me, he goes, from a pure, because, he lived in Quincy his whole life. His family's lived in Quincy his whole life. He is a Quincyite. And he was like, he says to me, he goes, so there could be a day where we build a new school. An example I gave over. And somebody's in line waiting to drop off their kid. The school they're dropping the kid off is also making a dividend payment into their 401k. And I was like, yeah.
That's awesome.
That's what he said. He was like, and we could do this with giving more access to the Quincy individual. And in the long run, potentially cutting down pretty dramatically on documentation costs. I told him, I go, sometimes it's called a Pareto improvement in economics. Sometimes there's just better choices.
Yeah.
And it was a lot of work. Rick usually takes maybe 6 weeks to drum up even a large bond deal. This has been about, what, a year?
Yeah.
Oh,
Yeah.
wow.
And there's a lot of things to work on, and all those benefits and all those the impacts of that Eric described is true. And I also think there's another thing that I think was really cool in being first. And it's not a metric. It's not something you'll get and say, well, is this decreased interest rates at this point, or your transaction costs or your documentation costs have gone down. Is that being first always loud. And this is what I applaud like the mayor and Mayor Koch and Eric on this and really driving this point home. It's like, look, when you're first, you also, there's always some growing pains when you're first, but you also have the ability to kind of shape what future deals are going to look like. You have a seat at the table on how the selling of blockchain municipal bonds is going to take place. You've done it. You've been through it. Other providers are probably going to seek you out because they know you're open to it. You'll have a say on, all right, this worked really well. This is where I think we could probably do better because you've already been through it. Right. So being being an early adopter gives you some advantages as opposed to like, well, this is the standard. This we've set precedents here. This is where we got to follow, and which is not necessarily true for early adopters. So.
And with our experience of the pension obligation bond, we acted fast. I was actually sitting in this room, December 12th, 2021, a big TV over there, and watching the sale come in. And we hit the bottom of the market, 2.62% on it, and everybody was still trying to figure this stuff out. Like, oh, should we do it? Should we do it? And then rates jumped, and it's still economically feasible now, but it's not
like it was.
Not the margin you had. And again, to that point, like Eric's phone, being the chief financial officer, he was getting calls from chief financial officers across the state. Again, it goes to be that not that issue of pension obligation bond. You're an early adopter; it's been around for a while, but they were asking advice. How should we do it? Does this make sense? Does my math? They were sending Eric their homework. Saying, like, does it make sense? So again, you have the benefits of already gone through it, and so you have your opinion matters to people who are looking into it.
Yeah, and that's the benefit of having a strong chief executive. Like the mayor was like, I want to do this. Let's start exploring it. And we were able to drum up like Milliman for our actuary services. We were able to form what's the word we use when you have we have all the different underwriters. It has a cool name.
Oh, a syndicate.
Syndicate, yes.
Oh God,
such an awesome name, but we should probably not use that name.
Greg Godfather.
Yeah, Greg Godfather.
Shadow Counsel works well too.
I would say kitchen cabinet, like under Andrew Jackson, but John Q. Adams is buried pretty close by, so I don't want to be insulting him.
Well, when we're talking about like upending the business and maybe potentially ruffling some feathers, I think the one that I'd be most concerned about would be the underwriters themselves. It seems like they have the biggest stake in the game. They're probably the ones who make the most money on these types of deals. But it seems like JP Morgan is the one that was basically developing the technology that this is being listed on. So this isn't something that they're trying to suppress. This is something that they're embracing. And that's what's exciting as I learn more about this project.
Yeah, absolutely. The guys who used to print bonds and they used to be in paper are probably pretty upset when they moved to computers.
Right.
Except the guys who, bought a website.
Exactly.
And I think that's kind of what we're looking at here with like JPM. Is their Onyx platform was pre-built. And they've been working on it for a long time. Like the JPM team is massive, very supportive, very candid. I think I was one of the things working with them was like they're just honest. And one of the things I found very interesting working with JPM is they could explain everything, every single thing they could explain on it. It's like talking to a mechanic who could tell you how the gap on a spark plug it was.
Right.
And we do expect that from underwriters, and our underwriters for our negotiated debt sales do that with us too. Like we can call Ramirez and Company, they'll tell us everything. Like their bond analysts down there are amazing. They're absolutely like top tier. Like really, they have like Kyle, we've talked enough. That I'm an analyst. So like,
right.
I mean that my full nerd out how excellent they are. But I think it's innovation. Like I think as we go through these processes, I think what you're going to see is underwriters become more valuable because when you have an emerging technology, you need an expert. And as we have this emerging technology, you're going to see these underwriters who are willing to change and not just willing to change, but willing to be proactive in this. You're going to see them succeed. It's going to be more economically efficient. I'm one of those guys where like I've said this before. Like I like Milton Friedman, not my favorite economist, but also like denied to have an opinion on good economists. Sir Arthur Lewis is always my favorite. And it definitely didn't happen, but it's a famous quip where he was in China and they're like, oh, look at all these people digging like a dam. It's like, why are you guys using shovels? Why not have an excavator? And they were like, oh, because we have 100% employment with that. He goes, okay, give them spoons.
Right.
He really was an excellent economist at trying to getting people to understand stuff. He was.
Yeah, I didn't wear my Milton Friedman shirt today, but he just, as I said yesterday, he was very good about simplifying the economic theory to the masses. Right? So that was always I think the value that he provided.
Yeah, I agree with that. I do think his theories on money velocity.
Mm-hmm. He ended up being wrong, but
yeah, but it's
still good ideas.
Still good ideas.
Other ideas, right?
Yeah, I mean, is it his fault you didn't see credit cards coming?
Fair enough.
I'll just say this, Kyle, real quickly to your point about the underwriters. Yeah, I mean, there's always it's new. It's a new technology in underwriting. There's always an initial hesitancy and a trepidation because you're like, look, it's no, and you don't need to do it this way. This has worked for so many years. Why are you going to do? Well, you can try to thwart technology and advancement, but it's coming,
right?
And it's going to change the industry. Is it going to change it next year? Probably not. But it's going to take some time, and you can get on board or you can be left behind, and that's kind of it's amazing. As you and I have talked, I came from a different world. I was in the private sector, and I always thought I'm coming to the public sector. They're not going to embrace technology. They're not going to embrace change. Well, I was really, really pleasantly and really surprised. I think Quincy's unique about that too, and I think that goes to leadership, right? It goes to Mayor Coke, and it goes to Eric, and it goes to a senior team. I thought I was going to be bored. I am not bored.
No, I realize it's government's always a strange animal because you have some government that feels antiquated, you have others where it's it feels very modern. I mean, and then we talk about Mayor Coke's influence on this. He's the ultimate pragmatist. That's one of the funnest things about working for him. When I got into government, I started working when I was 21, but my academic background, I was going through it was government was sometimes seen as antiquated, and government is usually antiquated. Don't get me wrong, but it was seen as non-dynamic, and I thought that was interesting. And my mentor in economics, he worked he worked for federal government. Mm-hmm. And, he told me one time, he's like, government depends on leadership. You can be very innovative depending on who's running the show. And I've never seen that more in Quincy. Like, I really, like, it is quite, I tell, like, I have buddies working government all across the country. I'm an economist, so half my days work in in the public sector, right? Like, and I tell them what we do, and they're like, you guys get to do stuff like that? And I'm like, yeah, and we right now in Quincy, we kind of have this like unique combination. We have, our mayor who's pushing, who always wants to push innovation, how to make things more efficient, how to take the public dollar and get more out of it, which I love. That's my favorite thing about my job. I know it's as nerdy as that sounds, but I love the idea of like, you have X hundreds of millions of dollars. Can you get more out of them? Can you maximize that? And to have an ecosystem around here where that's the objective, where that's what, the mayor wants to be done. But then you combine that too with right now, the city council, like I mentioned earlier, city council president, Ann Kane, who knows this, who's really knows how this stuff works. And you kind of get like that moment where, uniquely happens in government where the environment's right to try and take on a new challenge, and a new challenge that as we go down this road could really strongly benefit not just the city's financial picture, but the citizenry. And, sitting right now, we are seated 60 feet away from John Quincy Adams.
Yeah, we were in there yesterday.
Yeah, like John Quincy Adams is credited with starting the public service in the United States. And we're actually sitting right below his office. So where we're sitting right now, his office was above us when he was in Congress.
Awesome.
I don't know. I feel like it's full circle. I feel like that's what we're supposed to be. We're not just supposed to mail it in every day. Like, we're supposed to come in and say we're professional public service. All right, be a professional. And a professional tries to take the resources they have and get more out of them every single day. I think this is an example of that.
Yeah. Yeah, and I think there's a great symmetry thing. We didn't talk about, what this money is going to be used for. It's $10 million. And like the elegant symmetry of it is we're using this avant-garde technology, right? And what is this? We're going to be issuing $10 million of blockchain-based bond. And what's this money going to be used for? Well, it's going to be used for the old school paving of roads, sidewalks, improving side streets, curbs, side curbs. So I think that like there's a nice symmetry to that where you're meshing new technology with old school needs. Well, municipal needs.
You said roads. Can we double that?
We spent so much on it. It's funny. We went out to dinner last night, and I know you guys are originally out from out in Arizona, and I'm very jealous of the space Arizona has,
right?
And not freezing temperatures. So we did a $100 million road improvement plan like 4 or 5 years ago, and I remember one time I was up in front of the council, and I was asked, well, how much road liability do we have? And I was like, that's a wicked smart question. Like, and so I want to sit down and do this. $800 million is the roads in Quincy.
Wow.
So like $100 million is a great start and a great movement. And, we get about $2 million from the state in Chapter 90. Mm-hmm. But it's just like so much road liability because like the minute you get a crack in a road, you host. Like, right. Because of where we live, it's like freeze thaw, rips it apart. Though the left turn, Kyle, not to go off topic a little bit, but you guys have some pretty heated opinions about the left turn lanes.
Yeah. Like, it'd be nice to have them.
I think Laura brought up a funny point when we were at dinner. She's like, "Yeah, you guys are in like Oklahoma City, and they don't have left turn lanes anyways." Like, at least they have space to do left turn lanes.
I know, right?
Though I will say, Kyle, we were on a point about Massachusetts drivers just like not staying in their lane.
I do want to say, if you're listening to this in your car, just let somebody in. Make somebody stay nicer.
So yeah, that's why you can't see the yellow lines because it's just rubber on top of them.
Longtime fans of the show should be familiar with the lender formerly known as Sue Pullen, and I'm pleased to announce that she's back, fresh off a rebrand and ready to help as Sue Mackey. Sue is a certified mortgage advisor at Fairway Independent Mortgage, an equal housing lender who focuses on finding the right product for you and your needs. She has over 20 years of experience helping thousands of homeowners. Whether it's purchasing, refinancing, or even a reverse mortgage, Sue will help. Sue's licensed in 36 states now, so reach out and let Sue Mackey it happen for you. The best way to reach her is to just give her a call at 520-977-7904 or in an email, spullen@fairwaymc.com. Fairway Independent Mortgage has an MLS number of 2289. Sue Mackey has an MLS number of 206048. That email again, spullen@fairwaymc.com, and that phone number is 520-977-7904. Shoot Sue an email and let her know she needs to update that address.
So we kind of talked about like the vision of what you guys think this is going to lead to. Does JPM share that vision since this is ultimately their technology that's listing on? Like, do they have plans of like creating a secondary market or exchange where these can trade like maybe on a daily or weekly or monthly basis? Or is this going to be something that they package and like stick into like their 401k type uh, options that you can choose from your retirement?
Yeah, so Steve Rick and I will bounce back and forth on this one. So right now, so it's in its from a proven technology base. This is a mature technology in terms of like they know how the system works, but it's early market for how it interacts with third parties.
Right.
So like the city would never engage with a technology that's not proven out beyond a reasonable doubt.
Right.
And like I mentioned earlier, this technology is a lot safer than in many cases than traditional digital bond payments because it's blockchain. Like there's literally not enough computing power on the average, even get a bunch of computers in town together to break that data continuity. And also like the way the bonds are paid, like I don't know if people know this, but when you pay a bond, it gets wired in, and that wire has to be done in a certain time to an intermediate US, like for us, it's US Bank. And if that wire doesn't hit in time, even if the city put it in early enough, that can result in default. So that's why Molly Smith, our treasurer, on days of bond sales is
frazzled.
Yeah, no, not frazzled. She's very cool, calm, collective.
Really,
she can be very assertive in making sure that the city's wire is top priority, and our banking partners are always very happy to oblige to that.
We showed up for this like 15 minutes early. I can't stand being like even late for minor appointments. I can't imagine having something like that hanging over my head.
$1 bond, yeah. So with the JPM technology is that we have a JPM account and it's automatically taken out of that.
Oh, that is awesome.
And automatically pays across the digital ledger to all these people. And that's only possible with digital ledger technology, with blockchain technology. Now, JPM's vision, it's kind of hard to speak for JPM. So I don't want to I'll say our perspective or my perspective on how I view JPM's process on it. I think JPM's excited for this. I think JPM sees themselves as they already have people on the platform. And it is about the secondary market. I think they're trying to create an entire ecosystem. Right. And forget about Eric Mason, the CFO, but as an economist, I'm excited for that. I like when somebody's like, let's create a new market and lower the barriers to entry. Let's make it more efficient. Let's make transactions as quick and as seamless and settling. Let's think about blockchain. You can settle immediately. Mm-hmm. I'm excited for that. I think that I bet that you have JPM, which is like the size of a country when it comes to economic power. They got some smart, motivated people in that office who I bet they have plans for 30 different ways it could go. And I know one of the plans they have is going to be right. Like I know that. My thinking, and I've said this on some of the calls with them, is I think there's a good chance it's just massive headwind. That's a tailwind. I think it's just like an opportunity where once people have access to this platform, from the biggest guy to the smallest guy, it's going to become the easiest way to trade on the secondary market, municipal bonds. And you're going to create, or any bonds in general, you're going to create that velocity. And once you create that velocity, I think it's a self-sustaining reaction.
No, you're absolutely right. And to the part of your question, Kyle, where you talked about are they looking to create a secondary market towards inlands? And the answer is yes. The answer is yes because while we were going through this deal, and one of the reasons the time frame for us was, well, we need the funds at a specific time, and we wanted to explore this avenue. So it kind of worked out really well as to why we're doing it in April. But parallel to that, JP Morgan is having conversations with other firms who are large, who are kind of your usual suspects. I'm not going to mention them, but who wanted to take part in this, and they would have been on the primary issuer or the primary buyer of these bonds. The timing isn't working out for them, but they are aligned and they are planned to be in that secondary market. So hypothetically, JPM buys these bonds and they want to sell them in 2 or 3 years. They have certain firms that are already aligned saying, yeah, we want to take part in this process. And, and Eric and I have been on some of those calls where they kind of, because of our backgrounds, we've been on some of those kind of, I don't want to call them due diligence calls, but those introductory calls and to explain their technology and how this works and our timing and everything. And the response has been very, 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 very positive to the point where again, some of the firms are like, yeah, we want to take part in this. And that takes some time. You have to open up accounts and things like that. So it probably won't, the real simplistic way of saying it is probably not going to happen in this go around. But I can see in subsequent issues that they are going to have a secondary market already built out, because they are working on that end as well as completing this issuance. They are working on building out that secondary market lineup of investors.
We've talked a bit about like how process itself. I think you guys mentioned in the beginning that the process for this one isn't necessarily any different than any other bond that you guys have issued in the past. The only difference is that the blockchain is integrated on this and it's got the potential. So were there any other potential risks with pursuing this route? Was it unanimous with the council supporting this? Because I know even with the pension bond, I think there was at least one person who was trying to fight that.
So to kind of answer the first section about the council approval, state of Massachusetts is kind of weird. So the chapters that basically allow the council to borrow, so the council votes to authorize bond sale, and it's an executive function on how you sell those bonds. So you have the option, this weird thing, you could privately place debt in Massachusetts. Like I could go to a bank, or actually, let me rephrase, under the law, the treasurer could go to the bank. Like, yeah, I have authorization to borrow $30 million. And if a bank was like, yeah, sure, there you go. Completely allowed to do that, which is wild to me, right?
Right.
Then you have the option of competitive debt sales, which is, everybody puts their bid in on a day, rip it open, sell it to the lowest bidder. Negotiated debt sales, which is really, we do competitive debt sales usually for BAN.
Yeah, because you're right. They're just rolling over.
Yeah, rolling over most of it. It's lower issuance costs. It's a better strategy. And the negotiated debt is for bonds, because it's much longer term, and that's when Rick and our underwriters get to fight it out in the free market, and one of my most beautiful dance and nicer. And then we have options like this. I mean, this is really more like a negotiated kind of, or maybe this is probably closer.
Private placement, direct placement. That's it.
Direct placement. That's what I was looking for.
Okay.
So while the city council authorizes and endorses the debt for the purpose of roads and sidewalks, they don't, by statute and by charter, play a role in the actual what the mechanism
It's just how it's done.
With that said, like Ian Kane, council president, he's somebody who we have sought advice from and sought knowledge from on this, and he's been supportive of it. But that doesn't result in like a vote for it.
Okay.
In terms of the process, the hardest part about this process has been sussing it out, for lack of a better term, is to understand it, because at the end of the day, we're fiduciaries, which means we have to completely understand the financial position and the financial process we're putting the city into. Rick and I come from very different backgrounds, and that's part of the reason we work very well together. Rick is a traditional finance expert, MBA, CFA, everything you want to see on the side of it. I'm some dude who's really good at R programming and likes to ramble about economics. And
Some other things.
Yes.
MBA, my master's in economics and published economics. I think he's downplaying a little bit, but yeah, we do it slightly different.
Yeah,
He's by no means a financial hack. Okay, so let's not. We know that.
it's and one of the parts that really makes it work on our side is my entire professional experience has been in public finance, and Rick has done great in public finance, but has an incredibly impressive private finance background. So when you bring on new technology like this, you get a lot of coverage, and so we were able to put together, I don't know how to call it, like a dossier, questions and understandings. And you team that up with people like, Rick Manley out of Lock Lord, Mike Mettinger, those guys.
Molly Smith,
our treasurer, who she comes from a private sector background, and then she started at CDBG as their finance director, so she knows the federal grant side. Now she's the treasurer of one of the largest cities in New England. And then you get like Cinder and McNerney and Lisa Driscoll from Hilltop Securities, and you got Dr. Dormy and Dr. Eric Olson from Wilmington Consulting, and you just keep expanding this, and John O'Keefe, Justin Natal for Blockwise, and the whole roster of individuals who, honestly, I'm probably forgetting some now, and I apologize. But we basically put that team together and said, okay, break this. Tell me this is stupid. Make me not want to do this. It's like I say this to my auditors every year. I say this to Jim Powers and Todd Jersky at Markham in Boston when they write my management letter. I'm like, hurt me. I want you to tell me I'm not doing everything perfect. That's impossible. I want you to write that down there. And we take that same approach when it comes to this deal. The problem is that it was just a lot more stuff to go through. Right. But our big concern on this was federal regulation. I got to tell you, Bondwich, is that the
Bowditch, yeah.
Bowditch, yeah, which was JPM's. JPM was brought on the team to look at the legal side. Those guys, they were thorough. They were very, very thorough. And so then you partner with you borrow JPM, and we go through this process. And it took like a year to go through, to understand everything.
All in, yeah.
Because as fiduciaries, we are never going to enter the city into a position that if we have the option to sell a bond traditionally, we should do that. Absolutely. Unless there is a mechanism that can protect or promote the financial health of the city. So if at any point during this process, there was something here that's going to be a threat to the financial security of the city, it would have stopped immediately. In fact, that was one of the mayor's first directives. He said, I'm interested in this. I love the idea. Keep going back to the concept of a Quincy resident investing in Quincy and getting tax-free returns. That is an awesome idea. That does not, there's no negotiation to a threat to the city's financial health.
Right.
And as we went down this road, what we very quickly realized is that this offers protections that traditional bonding can never offer. One is we've had it's been public. We've had cybersecurity threats at the city, and we had one where our ERP got assaulted. And I got to tell you, Brian Glavin, the IT director, and Brendan McVeigh, who basically run our ERP, they never got any sensitive information. The system worked perfectly. I made a comment to Dylan's call one day. I go, we found out the airbag worked.
Right.
Don't want to know the airbag worked, but we found it out. So we understand. We've went through that. We went through being locked down at Munis because that's our ERP, because it shut down when it detected a threat, and they did a good job. The system was in place, but we couldn't even get into our own system. So we were like, Rick was calling up one of our banking partners and being like, "Hey, can you print a bunch of money market checks for us
Immediately, by Friday, yes."
And of course, our banking partners were like, "Yeah, sure." I'm like, "Wow, I did not expect a yes from that." So we have a little bit of sensitivity to that.
Also, I just want to get a quick shout out to your IT group here. I've never met a more polite, helpful IT group.
Oh yeah, Richie
West.
Oh yeah, our IT guy's awesome. Richie's pissing. Like he's just, you call him up with it. He likes challenges too. Like he's one of those dudes who's like, "Oh, okay, I'm gonna give this a try." So we're really sensitive to cyber threats, and you couple that with like Councilor Kane's like background in this. We all kind of get that. We're all familiar with it. And, it's kind of like, I'm a nerd. You guys know that. Like, I love this. So we start talking about blockchain technology, and it's like, well, we have cybersecurity threats. And I had somebody, I had I forget who asked me at one time, but they were talking about basically the difference between, like, what is like a blockchain. And the example I always give, Kyle, I've said here before, is the first blockchain was a passport. Like, you can walk around with something that you carry, and it can tell you where you've been, how long you were there, and all that stuff. And I said the block on that blockchain carries such a near impervious, ability to be hacked, solely because it's just so dense, the numbers. It's just the ability, the encryption to break up a blockchain is comically high number. Like, you couldn't get a computer to do it. I mean, you get a quantum computer to do it, and obviously, like some of the tests showing, like the new 28 or 20 qubit computers and stuff like that have been able to break stuff like this. But even they struggle. Even they really do struggle. So it's like you'd have to have like an entire nation putting resources. Even honestly, like most nations on Earth couldn't even gather the resources to attack a blockchain. But if they ever had to attack a digital bond, I mean, they're safe. Don't get me wrong. Blockchain digital bond sales are safe. They're incredibly safe. They're incredibly encrypted. This is just a greater level of encryption. And so when I look at it, I go, what's the threat here? Oh, it's a safer process. Oh, by the way, the fact that they just pull the money out of your bank account and immediately distribute it,
eliminating that headache.
Yeah, right.
And to your question, Kyle, about was there any I don't want to say pushback, but was there any concerns and the risk and de-risking? A lot of it was on our side in terms of like going through scenarios of what if scenarios, right? In Eric's world, like you have an economic proof, right? Okay, so you put out that economic proof. Now every other economist is testing that proof to make sure it's airtight and it makes sense. And we did that as well too. And the doomsday scenario would be like, what if the Onyx system goes down, right? What if technology blows up, right? how are you going to do your debt payment, right? And, kudos to Molly Smith, because she always brought that up. It's like, okay, what if the systems go down the day that we need to make $1 million debt payment that is supposed to be immediately taken from a blockchain depository account to JPM so that they can pay our bond holders? Well, we have a backup plan. We can always go back to a traditional way of doing it as well. So that never goes away. But so I guess that's a kind of a long-winded answer to your question as to, how did you kind of, was there any concerns about risking and the risk inherent in this? And Eric's right, the security, that wasn't our concern. It was, what if we can't make our debt payments? And believe me, we spent enough time on that through Molly Smith, Eric, Rick Manley, our bond counsel, to make sure there were things in place to say, like, if hell went to a handbasket, we'd still be able to do business as usual.
It's and again, JPM was incredibly upfront walking us through all this. I'm sure they probably, we asked every question probably 3 different ways, and it was, it's funny. I mean, we know how these processes work, so it was just pure de-risking, and we spent a long time getting through that. I mean, it's not like they were building the Onyx platform as we were doing this.
Right.
It was already existed. We were poking and prodding it to seeing how it fit with us.
Seeing if you can break it.
Exactly. I mean, because here's the thing. We could walk away at any point we wanted to.
Right.
We go issue this bond. If we say, we don't want to do this work, you go issue this bond. We're going to have that debt in the market within 24 hours. It would be all bought up, and it would be no issue here. But we're like, let's take this opportunity to see if we can kind of redefine the game here and bring this closer to the individual citizen.
So eventually then, what do you think that process is going to look like? Do you think the public will ever be involved in like the initial offerings, or is this going to be probably something that's relegated to the secondary?
So the long-term goal is primary issuancy, and I know that sounds crazy, but like that's a goal.
It does, but doing it through a blockchain type platform or blockchain based thing seems like it makes that a lot more feasible.
Yeah, like the ideal goal, and this is like if somebody said, Eric, you can create the ideal situation, it would be a blockchain that would be available to be purchased day one, right? By as a primary issuance on a unit basis of a penny.
Mm-hmm.
That would be perfect. Now, there's some practicality to that because you still have underwriting and stuff like that. You still have the, right now there's been multiple times in the United States where people have done local preference bids, and people can call in and try and place a bond order. That can be a little problematic because I think a lot of people are confused how municipal bonds are sold, where you're like putting in a rate, like, hey, I'll give you 3.5% on this bond. But somebody come in and say 3.47%. And I don't want that individual to feel like, oh, did I just lose out on the bond? Well, technically you did, because there is one rule that not one rule, but there's one primary thing that Rick and I always have to consider. Rick, Molly, and I, as fiduciaries involved in this, we need to get the best price for the city.
Right.
That's our primary goal. Now, you can make considerations for, efficiencies over time and stuff like that, like any interest rate analysis you do. But you just can't say, oh, if you live in Quincy, you get an extra 1% on the bond. Like, we're not allowed to do that. No. What I think is going to end up happening, my personal belief here, is that you're going to see, and this has happened before with local preference issuance. You're going to see local preference issuance, but you're going to see it on a blockchain basis, which you're going to allow people to engage in it similar to a trading platform. You're going to be able to put in, like, when you buy
so like an IPO where you try to subscribe to it.
Right, or an option where you say, I'll buy it at this price. And you'll have this giant pool of investors. It won't just be Quincy people, it'll be anybody all over the country who will say, I'm willing to pay this amount, I'm willing to pay this amount. And it will just operate like a, an ask bid process. And, after the day of sale, click, you log in the next day and you see that, oh, hey, you got $10,000 at the rate you wanted. That's the ideal scenario. And there's nothing really from a technological standpoint stopping that right now. What's stopping us right now from doing that, and I don't mean us as in Quincy, I mean us as a financial market, is that's a new technology. It's like, they didn't invent the car and start racing them, right?
Right.
Racing was very dangerous. I think it did. And because this is heavily regulated, as it should be, I'm not the biggest guy saying everything in the world should be regulated, but financial assets should absolutely be regulated. I do think there's a little bit of a curve as the federal regulation gets comfortable with this. I think once they see that you have increased security, you have increased actors in the market, so you're going to be suppressing interest rates, and democratization, it becomes a very weird thing what's not to like about it. But the long-term goal is that you're 7 p.m. work, you're sitting in your house in, I don't know, House Neck, got your iPad in front of you, and you're like, Quincy's doing a new fire station. All right, let me, okay, can I get 10,000 and I'll put my bid at 3%.
Oh, that's right down the road. Hey, I'd like to have some better fire.
Look at that school. They're building a new school in Squantum.
They finally, there we go. Like, oh yeah, they paved my road back in up Kyle's left turn lane.
More immediate.
But yeah, it's so yeah, the long term goal here is, I know I sound like a broken record. I keep saying the word democratization, but it really is. It's bringing it to the people. Government shouldn't be picking winners and losers. It shouldn't be like restricting markets just because somebody has more zeros in their bank account.
And we've talked in the past, I don't know if that's ever been on any of the episodes we've recorded, where you talked about an experience in Oklahoma sitting on the energy board.
Yeah, on the Tulsa Energy Board. It was something funny. One of the guys I sit on there, he's a pretty big company, so I'm gonna refrain from saying his name. But he's a good man. He has he's had a very successful career, and he's from Oklahoma, and he wanted to buy bonds that were being issued by the municipality he lives in, and he was basically told he wasn't effectively liquid enough or wealthy enough to open an SMA to buy debt, and he was like, he kind of like asked him, he's like, well, so nobody can do this. And I thought about that and I said, okay, the system's broken. It's not even that it's just, excluded for people who are, high net worth individual, ultra high net worth individuals. This man would be.
He'd be way up there.
It's like, no, the system's broken. Not broken. Broken's a bad word. I don't want to use the word broken, but it's
not efficient.
Built. It's not efficient, and it's not built for the people that a city serves, which is its citizenry.
Right.
Let's try and keep. So to me, it's like, let's keep that $25 million in Quincy. And, when Rick and I talk about this, and we work with the mayor on it, and he hears about increased access to better financial vehicles for individuals, keep $25 million pumping and flowing through the economy of the city. You mix that in with the council president who gets the technology and is interested in it. We were just in a very unique circumstance in Quincy where we had the will to do this.
Correct. That's a big part of it. And I'm going to tie this way back to kind of the point Eric made earlier when we first started talking is, could you go to Fidelity and buy a municipal bond mutual fund? You could. The transaction costs and the management fees would probably be a little bit high. But the thing is, as he alluded to, like, you don't know what's in that bond. Like, if you want to invest in Quincy, Massachusetts debt because it's going to fund those projects that are important to you, you can't do that. You could maybe buy a New York bond or a Massachusetts bond that, you don't know what those underlying securities are underneath. Or you can, but there's a pretty good chance they're not going to be 100% Quincy debt, or they're not going to be even a majority of the debt.
It's going to be a basket.
It's going to be a basket. Now, if you just want the bond, that's fine. But this is totally different. This allows you, as like you said, a Quincy resident, to be like, I am really a supporter of the new school that's going in, and I know they're issuing debt to fund that.
I want to make sure it goes through.
I'm here for that, and here are my dollars that vote with that. You can't do that right now. You can get municipal bond exposure, but it's a different animal.
Yeah, and no, Rick, just to jump off, that's excellent. And obviously your background, you're going to know this a lot better than me, but like, systematic risk in municipal bonds isn't really the same as systematic risk in, say, like equity. And when I look at that, I go, okay, like, so Quincy, if you're buying a municipal bond, you're not just buying something that's backed by the full faith and credit of the city of Quincy and our authority to tax. There's all these other systems like Massachusetts and all these other prerequisites that are required that really secure up that secure up that bond. And you may say like, oh, you have these ginormous municipal funds like Rick just brought up. I don't really think, if you look at the percentage, and Rick, yell at me if I'm wrong here, if you look at the risk of exposure, it exists the same as the difference between an ETF and an individual stock.
No, that's right.
Again, this is why Rick is very valuable to have around. like I will ponder, like, let me think about something. And half the time Rick's like, well, no, Eric, that's not how that works. But the other half, he's like, no, you're the right track.
Right.
But yeah, it's just been a really interesting opportunity to kind of do something that, I don't know, to be honest, to do something that I never thought would be something that'd be done. And certainly nobody thinks of government ever being the first guy to do anything like this. And, I give a TED talk on this. Government's different at the local level. We're just different. I think the functionality of it's going to be crazy. And you know what's funny? Lugano, Switzerland issued the first one. They're a municipality, like they're a local government.
Right.
So it's like no state's done it yet. I mean, you had some people, you've had the Marshall Islands, try out. They never really did it.
Yeah.
They try out, the Marshall, I think they called it the gold or something like that, but the Marshall Island. But that was more like a blockchain-based currency. Estonia has like the e-coin, but that never really took off. Russia had like that petro coin, and so did Venezuela.
We don't worry about what Russia does.
Yeah, two heavily sanctioned countries coming up with a blockchain currency was not super smart. I don't know where I was going with that.
No, it's
Saying local government.
I think you're absolutely right. And this is where your opinion you could weigh in on this is, yes, it is surprising that have a local government that's embracing new technologies, embracing new ways of issuing their debt. But I don't know, Eric. I don't know if there are a lot of municipalities who would have the fortitude, let's say, to say like, oh, let's break through the glass. Let's be the first one through the door, doing all your due diligence and testing it and making sure. I think most municipalities would be apprehensive and be like, well, let's make sure it's been done. That precedent has already been set, and as opposed to saying like, with you and the mayor saying like, let's try this, let's do this,
Somebody's
and I don't, because this, full disclosure, is the first municipality I've ever worked with, and maybe there are kind of more other, maybe larger cities that would have this tact, but that would do this. They would just, it's just not the way it's not the way they do business or traditional ways, and you have to have a leadership that's open to.
Yeah.
Well, yeah. When you're reporting to 100,000 people, it makes it hard to take risks.
Yeah.
There's an aversion.
Yeah.
Risk aversion.
Yeah, and I think what's kind of funny, something I've noticed with municipalities and kind of what we're doing here is, they talk. You guys said the word perfectly. It's risk, and they go, is this a risky process? And some of the people we've talked to on this so far, in private, we obviously don't disclose like the process or anything like that, but just kind of the general idea. And I hear that word risk, and there's in government, there's this kind of assumption that change is risky. It's not always true. We looked into this process. I would make a bet that we looked into this process on how to issue a bond on this platform and through this process better than most municipalities look into how they do their negotiated and competitive sales. Right.
No, I bet.
We understand this process, every single bite and bit of this. And so when I talk about risk, I look at that, I go, yeah, it's risky if we didn't do the due diligence. But a year worth of homework is sent through, and I saw this. We were able to talk more publicly about the pension obligation bond because that was a little different. I saw that with the pension obligation bond. I saw individuals like from other municipalities call and talk to me, and I got lucky enough to have that the hill to pick up that op-ed. So I got calls from all over the Commonwealth and all over the country asking me about these, and it sounded the exact same. It was like risk, and I kind of said to them, I go, "What's your alternative?" And I go, "We'll just pay the unfunded liability." I go, "So you pay the unfunded liability? I go, what's your discount rate? Like 7.1%. Okay, so you can borrow that at 2.6%. So where's your risk?" And they were like, "What do you mean, where's my risk? I have to pay back the note." And I was like, "And you have to pay the unfunded liability." I go, in economics, we talk about things on the margin. Mm-hmm. We don't talk about risk. We talk about riskier. We don't talk about, we always talk about the change in things. And so I said to them, I go, your risk is not doing this. It's called opportunity loss.
Yes.
And that opportunity cost is one of those weird things where you can't physically see it. So it doesn't feel like somebody's taking something away from you here. Right. It's an opportunity cost environment right now.
Funny, you're bringing me back, Eric. I remember that conversation we had with the mayor when we talked about. I know we're talking about blockchain. We did talk about the pension obligation bond, and it was like, well, there's risk. The mayor. I remember the mayor distilling it so simply. And I still have the unfunded liability, right? Yeah. We still have to pay that, right? Yeah, and we're paying it at this rate, right? So I can't risk that away. Yeah, this is a way of just moving it on the balance sheet and having more favorable terms, right? And like, yeah, that is actually the right way to look at it. That's why we did it.
You refinanced.
Thank you. Yeah, refinance.
That was very funny. He always cracks me up because he was just like, well, this number's 7% and this number's going to be 2 to 3%. Right. So I want the 2 to 3%. I was like, oh, I love working for this dude. I love working for this man. It's awesome. It's just like some people just, and I do love that ultimate pragmatism. Like, that is a rarity in government. I've noticed in my decade being around government of just somebody who's like, here's the ups, here's the downs, and we're just going to pick the better one. It's okay not to just follow the herd. I think that's the opportunity we're looking at right now.
And it's not like you guys didn't protect yourself too. I mean, I think you said at any point you could have pulled out of this process any step of the way.
And Eric said this too, is that JPM's been a great partner. So don't get me wrong. They want to get this done because, listen, I'd like to be altruistic, but everyone has their own selfish reasons for doing it. We want to be first because we think it's going to ultimately be beneficial to the city. It's going to save us costs, it's going to save us, more efficient, save us time, liquidity, and all those things. And JPM they want a feather in their cap too. They want not that this is a proven platform. They've done other transactions, but
that's what makes capitalism
exactly
when the interests align.
JPM can't be like, oh great, Quincy's willing to do this. If it doesn't go well, it doesn't go. Like JPM doesn't want that headline risk, right? Like they are the gold standard when it comes to investment banking, private banking, you name it, and traditional banking. They're going to move heaven and earth to make sure this thing goes as seamless as possible, and they get the headline advantage to it as well. And when they have the resources and deep pockets and reputation that can ensure that. So that's one reason we decided to go with kind of a captive platform with JPM, where you have to be on there to take part in this. You have to be on there. You have to have a custodial relationship with them.
Mm-hmm.
That's a kind of a sleep well at night factor for this, right? Like you're not dealing with a fly by night.
It's not the Royal Bank of Scotland or
right. I think they should be fine. I think they're well capitalized.
Yeah, it is funny working with JPM and like. It's funny. You work with that team, and they almost don't act like not act, but they're your partners, and you're going through it and all this stuff. And occasionally, I'll just be like on the calls, and I'll just be like, "Yeah, but you're JPM. Like you have more like more financial power than like every country that's not like the United States and China. Like the UK and JPM probably have the same ability to fluctuate markets, and they're very respectful, not to just be like, we have trillions of dollars, we can just deploy at something." But yeah, it's kind of funny to work with them because it's just that they don't like they're not out there being like, we're JPM, we can handle this. Like it's a $10 million deal. Like it's not like that's not even. I would be surprised if $10 million is material in their financial statements.
Oh, that's probably
that's around
that. Yeah, exactly.
Like, but they give you the same amount of respect and treatment as if we were doing like a $2 million deal with them. And I kind of like it because I think this has been a lot of work in this process for everybody. I mean, Rick's on calls 2-3 times a week with their team and his team, and it's 20 people, 25 people on the call.
Right.
It's gotten to the point right now where it's kind of funny because like the treasurer's on the calls too, and I was on a call. It was on Friday, and they're redoing all the windows on the side of City Hall. And so it's like there's a crane up there, so I'll be on the phone and I'll be on like the Zoom call. There'll just be like a hit of a guy rising behind me on a scissors lift, like repairing a window. Nice guy, seems like a nice guy. Wait, if he wants a Diet Pepsi or something. But while he's on the first floor, so they could see the scissors lift, like driving back and forth. And so when I went back to him because I all feel bad doing that about him, but he's basically like always interested on where the
fascinating. That project is not done yet.
Oh yeah.
He said in downtown Manhattan, right? Like
yeah. I mean, like that's what this process did. We become very familiar with the technology, and as we become very familiar with the technology, naturally we become very familiar with the people using the technology, to the point where this gentleman could probably tell you the exact status of the window repair at City Hall.
I love that.
Like he drives home. If he has a dog, he's like watching Jeopardy or something. He's like, still in the back of his brain, he can tell you what floor has its windows replaced and Quincy City Hall.
It's usually obsessed with the progress.
yeah, he's very.
So this is a complete aside, but did you guys have any interactions with Jamie Dimon? You got a question to him for me? I want to know if he's going to run for Fed president after Powell eventually steps down.
I mean.
No, I mean, I met him in my previous life. I had met him, but that's a great point. I mean, I'm a kind of a fan of his.
Yeah, I am too.
I mean, he's a smart guy, and obviously what he says moves markets and opinions matter. I don't think he would take the pay cut to take $1 million. But that's my 2 cents.
Yeah, it's I mean, Isaac's pretty high up there.
He is, right? Isaac Sines, who's the managing director at JPM. The great thing about, and
he's a hustler.
This doesn't answer your question, Kyle, but it is tangentially kind of related. Is that the one great thing about JPM is like they don't their technology is always kind of state of the art. They spend a lot of money. They have their own divisions that just I always use this kind of, and he uses Jamie Dimon. I've heard him say this before. they're a technology company that happens to do banking as well.
All right.
So that gave us some comfort. And that comes from Diamond, like his embracing of technology, of pushing for technology. I know he has some pretty strong opinions on Bitcoin and not blockchain, but that's great working with a company that is like it.
I mean, we have it wasn't disclosed as how much they spent to build Onyx.
Probably a lot.
It is a beast of a
Yeah.
like that thing. I'm a car guy, like looking at a Dodge Viper. You were built for power, not comfort, not to go pick up groceries. You were just built to 12 cylinders.
Those Hellcats.
Yeah, right. Small aside, we had a customer in the station when I was growing up. We got a Hellcat, and I don't know if it was his son, somebody in his family went to drive it, and didn't realize how fast it accelerates, put it into a telephone pole and pull out the driveway. You pull out your driveway, pop it into drive, and hit it. And I think the kid was still trying to turn the wheel. And the guy was so happy. Comes in the gas station. He's like, fill up V-Power. And tell how happy we were about it. And then the next week, of course, I'm an idiot. I'm sitting there, the guy's in this nice, like, little Ford Ranger. I'm like, oh, you didn't take the Hellcat out today? He just has some sourest look on his face. And he tells me the story. And I'm like, I'm going to go back inside. I don't want that.
Well, that was 8 in Bakersfield. I hit a brand new Corvette. It was like literally taken off the lot that day on my bicycle. Jammed up the front headlight door, wouldn't pop out anymore.
Were you okay?
Oh, I was fine. I was racing somebody down the parking lot, and the guy just kind of came out of nowhere. We were idiots. He sent one guy up on the bike to go check to make sure that road was cleared. He came all the way back. He's like, yep, you're good. I was like, oh, okay, yeah. Worst part was telling my dad.
Insurance claim? Like, how does that work?
Yeah, I think he was more concerned about hitting a kid on a bike. I didn't think of it from his perspective.
Oh, yeah. I mean, if you're driving a Corvette, a kid hits you on his bike, I'm like, oh, I got a Corvette. I feel weird, like, complaining about that. Like, oh, you hit my incredibly expensive car?
I know, right? So tell me what is this? What happens after the bond sale goes through? Because it's getting priced today, right?
Yes.
As we're recording this?
Yeah. Normally, post-bond sale analysis is an internal function.
Mm-hmm.
We have great analysts in our department. Reese Mullen is a business analyst. Rick will feign this, but like Rick's a really good analyst too. He understands bond market sales. So we actually have Dormanson Consulting under contract, and so Dormanson Consulting, particularly Dr. Jack Dormy and Dr. Eric Olson, have quite a unique background. Dr. Jack is 25 years in the Federal Reserve in Philly. He was a bank examiner. He would go into banks and, make sure they're happy and healthy. And Dr. Olson is the chair of Tulsa's Finance School, which has a prolifically great public finance program. So we have their company coming in to analyze what happened. Now, the reason we want to do this is twofold. One, we want to have internal documentation by experts who are third parties to tell us what happened with this deal.
Mm-hmm.
Now, here's the thing. It's a bond sale. As exciting as this day is and exciting as this process is, it's a municipal bond sale. All right. We're not reinventing the wheel here. When we talk about, having a conversation to understand what happened, we're trying to understand it's almost like, I know they don't use the Richter scale anymore. I forget what the term they use for it, but we want to basically see on a seismograph, how did this push markets? We want to track, the velocity of exchange post-sale.
Mm-hmm.
So it won't just be, it'll start day one afterwards, but it'll continue for a while. And we have so much great benchmark data for municipal bond sales. And we want to see how are we different, because we want to understand what that difference was. And I think bringing in third parties who are just experts. I mean, really, I don't think you could possibly find a better team than somebody with almost 3 decades of banking experience at the Federal Reserve. And another gentleman who does all this innovation, has experience with blockchain, but then also teaches at an excellent public finance school to tell us what we did and what that outcome was. And the second would be that report would be for public disclosure too. Like much like this conversation we're having right now, is so people understand our thought process and understand what the goals were. All right, great. That was the goals of what we tried to do. But let's bring on a third party and
verify.
Right?
Did what we think was going to happen, did that actually happen?
Yeah. I'm a big believer in FMA. It's actually part of financial policies. Forecast, manage, analyze, predict where you're going, set a course, manage to that course. But don't forget to turn around and see, did you hit your target? So this is the A of the FMA. Like, yeah, we're very excited to see what that report's gonna bring through.
When is that report going to be completed, do you think?
So there'll probably be an initial preliminary report, maybe 3 weeks to a month afterwards. And then there'll be what they're called like a totality report, probably like 6 months afterwards, as they begin to try and measure post-sale trading. Post-sale trading will be, I personally think, for economists, of course, I think trading is the most interesting aspect.
Right.
But I think to how much of a market disruptor it was.
We probably need to reconvene when that comes out then, because I think we're going to want to really dive into that report.
No, absolutely. I think that'd be very productive, and honestly, like similar format. I've said this publicly before, but when we talk about financial transparency, we put our basic financial statements online. We always do. You need to have an incredibly good understanding of GAAP and GASB to be able to just look at prepared financial statements. They should be online. People should have access to them. You should absolutely be able to look at them. But it's the reason we bring on ClearGov, all right? Because it makes it more palatable. You can type in your property tax bill and just keep clicking through till you know exactly how much we're paying, third grade teachers out of school. Processes like this, and again, I want to thank you, Kyle. I want to thank you, Laura, for coming down here and talking with us, because this is a hugely important thing. We're not the private sector. We should never assume we can be private about things. It's not how anybody in the administration wants to be, and it's not how how it should operate. We just did something that some people may say was monumental. Other people might say, who cares? Regardless, we don't get to decide opinion on it. What we get to decide, what we have to do, is that people like Rick and I have to sit down, and especially Rick, who went through this process, and myself being CFO, and create an environment where the average Quincy resident can come here and say, okay, what did my government do? What was the purpose of this? Whether you agree or disagree with us, I think this type of disclosure is important. I think when we have that data 6 months from now, and we sit down, and I'm sure we'll have another pleasant conversation, or you can yell at me, Kyle, that's fine, and say, hey, this is what we saw, this is what happened.
This is what we didn't expect.
We didn't expect.
Yeah,
there could be stuff that happens on here.
And there will be. I 100% assume that's going to happen.
To be honest with you, one of the crazy things I could see happening is this crazy post-sale market velocity of this thing getting traded a bunch of times.
Right.
And then it's the horse is off to, it's off to the races. Now it's no longer, is this a good technology for government to use or a bad technology for government to use? Should you examine using it? No, now it's like, whoa, look, that's secondary market trades. That's that was suppressed interest rates. And now all the municipalities looking around going, we might have to start doing this.
Right. Right.
And that would be, that becomes like, fusion. Like it's just self-contained reaction.
The really interesting thing is going to be, when does the next one happen? Who does the next sale?
I'm wiki. So we have some idea of who the next one's going to be.
Correct.
With a different market player. We have heard. Obviously, we can't disclose that. I'm curious too with you, Kyle. I'm curious about this, because I'm sitting there going like, it's never the first guy; it's the first follower that matters. I don't know. I think it could be really interesting.
I agree with that, Rick. I was really kind of put a button in, but I just think there will be a flurry, or quote unquote, a flurry of activity after, whether it's new issuers, whether it's potential custodians getting on platforms for the secondary markets, and I just, we've been close enough to it where we can smell the smoke. So,
yeah, there's a little bit of a space race going on right now. Like, a couple different firms trying to be the first.
That's right.
And for us, it's not about it being a race though, because we have to follow that fiduciary responsibility. So we just kept freight training along.
I mean, you want to be first, but you also want to do it right too.
Yeah. To us, it's always about maintaining that fiduciary responsibility primarily. And it's funny, it's this, slow, smooth as
slow is smooth, smooth is fast.
Yeah, exactly. Slow, smooth as fast. That's really how it was. Like, we had all these people popping up as we were going through this process who were trying to do it.
Yeah.
And we were that freight train, same speed freight train. And because we just kept on the due diligence part and kept on that momentum,
Eric had a big point of it. Like, what's taking so long for certain people to get on? It is the due diligence, right? It's the regulatory requirements, and when you're dealing with compliance and legal and regulatory like that, they go at glacial speeds. So
part of the problem is nobody knows what questions to even ask when something's new.
Right.
That was part of that. We went to, prior to getting our S&P rating for this deal, conversations had to be had. Say, look, we're looking to, we're in the market all the time. Our credit, our. Eric gives them our basic financial statements ad nauseum, to the point where they know everything, our revenues, expenses, everything. And they're like, so you're just selling bonds, and it's going to be on a different platform, distribution platform, right? I'm like, yeah. And they're like, yeah, it's nowhere will it affect your credit at all.
Right.
We're looking at the financial health of the city.
Yeah, exactly. That's one of the more interesting parts is that, like you brought up earlier, kind of like the council's involvement, it's authorization, the S&P's involvement. It's like, hey, you're making your payments. It's a $10 million note. Like,
Yeah.
And so we sit there and go like, well, what's the challenge here? And it's, I think, if we were in the private sector, to be honest with you, I think we could have been even quicker on it, but we wouldn't have the same incentives.
Right.
And that's what made this beautiful about this process. And it is weird that when, maybe people will care, maybe they won't. When you look back in time, it's like, who's the first person to do this in the largest market? It was government?
Right.
Maybe it's a paladin did this?
Chief financial officer. I got to give him a call.
Well, hopefully be working at McDonald's.
Well, I think, Eric, you got a meeting coming up here in a couple minutes, and I think Rick, too. Probably need to wrap this thing up. I think we did manage to answer most of the immediate questions that should be out there. If there are any, though, that people think that we missed, please feel free to send us an email. You can do that at bandoftraderspodcast@gmail.com, or you can do that via any of our socials. Eric maintains a professional Twitter that he likes to be yelled at on. As he can respond to.
I can't respond.
If we get enough questions through this, then I'll make sure that Eric knows the job's not done. We'll get him back over here and answer those. If you were hoping for more technical details of like kind of the nuts and bolts of how this happened, Eric, you just did a podcast that should be out by the time this is out.
Yeah.
What's the name of that one?
Rick was on it. Rick, what was the bond buyer?
Oh, the bond buyer. It will be. It's going to be on bond buyers. It'll be on their digital platform, and it will be. Do you need to know who's conducting it, or just
No, just where they can go to find it.
It'll be on bondbuyer. If you go to the bondbuyer.com, they'll usually have a nice link there, a big blue link that I post on their podcast section. I think they actually have a blockchain section of bondbuyer. So so you'll probably find it there.
You know when that'll be out?
Probably over the next week or two.
Okay.
Yeah.
So it should be out about the same time this is going up.
Correct.
So if you like what you heard and you feel like sticking around, please, you can go check out bandoftraderspodcast.com, where you can sort through the 100 or so other guests that we've interviewed. Make sure we have all these links in the show notes so people can find those. I will be back soon with another slightly less historical episode, but until then, share this with your friends like a Bay Stater trying to educate the rest of the U.S. about the significance of the Mayflower Compact, and have a great day.
Thanks, guys.
This podcast is intended for informational and educational purposes only. It does not constitute financial or investment advice and should not be construed as such. The hosts, guests, and contributors of this podcast are not licensed financial advisors, brokers, or professionals. Any trading or investment decisions made based on the content of this podcast are solely at the listener's discretion and risk. Trading and investing in financial markets carry inherent risks, and past performance is not indicative of future results. Listeners should conduct their own research and seek advice from qualified financial professionals before making any financial decisions. The views, opinions, and information shared in this podcast are those of the individual contributors and do not necessarily reflect the views or policies of the podcast creators or associated organizations. Produced by China Shop Productions.